Trading Market Technicals morning call video for Tuesday, October the 8th. Another down day in the markets. Dow down 139, Nasdaq down 35, S&P down about 14 and a half, almost 14 and a half handles, and dollar relatively quiet. Obviously, its performance is going to be held hostage to what the resolution of the debt ceiling is going to, what the outcome that's going to be. But nonetheless, I have a few charts I want to show you. I think we're down now 10 out of 13 days. In the very short term, we are oversold. That is not a buy signal, guys. As we all know, we can be oversold for quite some time before we get some sort of relief rally. What I've been looking at, and I still think that we're going to get some sort of a big bounce. And that's really going to be a great opportunity to sell into. Now, right now that is, but things change. Things change every day when you're doing technical analysis, right? You want to get the information off the charts and then put it to work in your trading style. So in front of us, we see the McClellan oscillator, and we're down about 36%. Really not much of anything. We're still within a zone of negative 60, plus 60. We need to start breaking below that. Now, we are at the bottom end of the Bollinger Band, but we really need to spike out of it, or at least get really down to these areas like here. We had a nice big pop here, here, and here, and of course here. So we can actually move down a lot more before we can really start looking for some sort of like rip your face off oversold rally. Now, the last couple of rallies that we had, a couple of bounces, were so muted that it really didn't give you a good risk reward to get in short or to lay in some shorts. And I also get a couple of emails. Well, what about Mark? Do you think we should? Is it a good idea to put any type of hedge on? No, not at these levels. You're already oversold. Where you wanted to put it is where you were. Where the markets were about 13 trading days ago, near the highs. Certain areas where we start breaking down and start rolling over, and you still want to hold your longs, yes, then you do it, not now. The market does rally and retrace. You want to get at least a good retracement rally. If you are holding longer-term positions, then you would put on a hedge, buy SPY puts, TZA calls, inversely correlated ETF, an SDS, a TZA, anything that you feel comfortable with, but not down here, unfortunately. So now, where do we go from here? Well, I do think that the debt ceiling is going to be resolved. I think a lot of these politicians are trying to trying to act accordingly, like they're doing their job, which I think is ridiculous. But nonetheless, they don't realize they're holding a market hostage to what's going on. And now, we are really at a point where we could either flush down really hard and get to a target of probably the 1658 to 1655, even 1663. That was the overnight lows about a few days back. So we did test it almost yesterday at the close. We had pretty much a hard selling for 45 minutes. It sold off pretty hard. Now in the overnight, we're just up and down, positive $1 to negative $1.50 in the E-mini S&P. So really relatively quiet, and it's kind of eerie because now, can we get another big push lower? Absolutely, and I wouldn't doubt that we would get a big push lower. That push lower, I would look to buy the market, at least for the day, as a day trade. And that's what I'd be looking for. If the market does in fact stabilize, and like it's doing overnight, and then we get a little push lower, and then we reverse right away, I will also look to buy that. But shorting the market here on the opening is just not the right thing to do. So we want to be selective in our trades. You want to be selective in your stock picks. The market is holding up relatively well, despite we're down 10 out of 13 days. Tech is still doing very well. Semiconductors actually very strong, and transports are doing okay. The weakness is really the Dow and the S&P. So let's just take a look at that when we get into the chart segment. Okay, so now you can see the McClellan oscillator. So to really get going here, we want to see this thing really start to excel to the downside. Tick still holding up well, guys. I mean, I'm not going to show you a bunch of them. Just right now, we're still above the zero line. Yes, we are rolling over, of course, but end-of-day tick is still showing us that we're above the zero line, so it's still positive. A lot of the indicators are still positive. Now, look at this. This is just out of control. We are the new low, $2. I mean, the markets, as you can see, this is a great indicator to show you where is the selling. Is it in stocks or is it in futures and ETFs? Well, it looks like to me, new lows, New York Stock Exchange, new lows. Not here, so it must be ETFs. As you can see, the indexes are selling off more than what the stocks are. Okay, take a look at the new highs. Still above zero. Now, yes, it is trending low, but still above zero. So, new 52 weeks new highs change is negative 119. Yes, we are still above zero, and we are lower, no doubt about it. But we are above zero. If really what happens when you start rolling into a bear market, you'll get these spikes lower, but you won't be able to get up above zero. You'll stay below zero and spike lower up to the zero line, spike lower up to the zero line when you're in a bear market. Right now, we're still in a bull market. We could even get down to 1650, 1600 and still be in a bull market. So just keep that in mind. Do not fall in love with the downside and the fact that you're going to lay out a bunch of shorts. Now, I do think that the markets are in trouble, but if the Fed continues to accommodate, you just cannot deny you can't get in front of that freight train. There's going to be a lot of proving to do for the markets to see that we're rolling back into a bear market at the moment, and we are not. So all of the indicators are still pointing higher in the longer term picture. The short term, yes, I do think that we could probably get one more big push lower. That is going to be a great opportunity to buy into the market going into the Santa Claus rally, and that's what we're only assuming, right? We don't assume that we don't think that the market. We want to think that the market is going to have a Santa Claus rally. Not that it has to, because it doesn't. We want just to play the game and let the market tell us where and when this market is going to either retrace back up or roll back lower. Okay, so I wanted to show you the indexes. This is from the 4th of October. From Friday, so I figured let's make a clean from Friday's week. As you can see, the biggest loser, Dow Jones. Next is going to be S&P, and of course, Amex. We're not looking at Amex. Russell 2000 up 0.012, up 0.012. New York Stock Exchange down 2.15, and then you have the Nasdaq up 0.64%. But you can see these two are leaders. I don't have the transports in here, but this is also holding up well. Okay, so these are the guys that are leading and going to need to continue leading. If money starts to rotate out of this sector, we have to see where it flows into. Does it come out of the market, or does it go into these safe haven sectors like utilities that are paying, that are just paying a dividend, and they're usually safer. They don't move as quickly as stocks that are the Dow Jones or the S&P. Okay. Also, now let's take a look at the VIX. Now, this is very interesting. We're outside of the Bollinger Band. We are at resistance again. Now, this has been chopped, right? We outside the Bollinger Band, closed inside. Okay, that was a buy trigger for the market. What about the previous day? Same thing. We closed back in, and then that was a buy trigger yesterday going into the market. Never happened. Boom, we pushed right back out again. This is new development, guys. This is something really different that's been happening. If you see, we had this, we sold off, markets rally. We had this, we sold off, markets rally. This, market rally. This, don't forget, when the VIX goes down, market rallies. This, market rallies. This, market rallies. So all of 2013, every time we had a pop up, we rally. Why is all of a sudden now this is different, you see? So this could totally change the picture. Maybe buying the dip, you'd want to buy it ever so slightly to your portfolio, because maybe things are changing now. Maybe buying the dip isn't the thing to do. Maybe buying the dip and maybe selling rallies is better than buying the dip now. We don't know, but I will tell you that I'm going to still follow the pattern here. So right now we are outside of the Bollinger Band. Okay, let's see what happens today if we get a pullback in the band, and then tomorrow would be a buy trigger for equities. Okay, at the moment. Now, if you look at the longer term picture of the VIX, this is not good. This is basing all of 2010, 11, 12, and now 13. And we're capped by the 200-day moving average, okay? If this were to break out and hold above the 200-day moving average for a couple of weeks, 2 or 3 weeks, I think the markets are going to be in trouble. And this is what you want to be basing your analysis on when and if that happens. VIX weekly, keep an eye on it, guys. This is going to be a big telltale sign. I mean, do we run up to here, to 40? I don't know. But I do think if the markets continue to get accommodated by the Fed, I don't think you're going to have it. I think you could sell volatility here. But at the moment, this is not good. This is a big, huge base forming, and if it does break out, look out below because the markets are going to take a big hit. Okay. Right now, again, this has not happened, but I just want to show you the bigger picture. Right now, we're looking at the daily chart, looking for the pullback and the buy trigger for equities. Okay. So let's just keep that one step at a time. All right. Let's take a look at the markets. Literally, I'm not going to. This is nothing really has changed. Inside day on the spiders, still holding that fib cluster of 166.60. Again, a break below that, we'll go into the bottom of this next cluster, and then a 200-day moving average. Okay. 30-minute chart in the spiders, really not much here to tell you. Again, we're looking for the pinching of the Bollinger Bands, like here, and of course here. So right now we're a little bit too wide, so it needs a little bit more work, a little more consolidation before energy builds and the markets move higher. Now, fib cluster 149.77. We lost it on the diamonds. Now the next really target would be 147.42, which would be this little consolidation area, this pivotal low, which will probably, when it does get down there, coincide with the 200-day moving average. But the 200-day moving average in the Dow is no question in sight. Here is the IWMs holding up relatively well here. I mean, this is really one of our leaders. We do not want to see this market break down, especially Russell. We don't want our leaders to start breaking down, because then that's going to really put additional pressure in the markets here. Transportation sector holding up well. Yes, we are below the 20, but we're above the 50 and way above the 200. This long-term uptrend line from November 2012 lows, we're still far away from it, but if it breaks the 50, that will be your next area here of support. And we have Goldman Sachs. What can I say? Goldman is breaking down, and 200-day moving average will coincide nicely with the lower, this pivotal low here. This is not looking good. And if the financials continue to lag and start to really break down here, I think it's going to add fuel to the fire of additional lows here in this market. So we need to see this really start reverting and breaking back above 156.56 and taking out 160. We really need to take out 160. If we don't take out 160, I wouldn't really be looking at this. I wouldn't be shorting it either. I mean, obviously, we're down, again, 13, 14 days. Well, actually, 11 out of 13 or 14 days here. So this is just totally in a downtrend, bearish symmetry, lower lows and lower highs. So if we can't break back above it, and if you're looking for a retracement round, that's a whole other story. But even then, I don't see anything now. Things has changed. I was looking at more like here. We broke out of it, maybe rally 3-4 points and then fail. But now, this really needs a lot more work to do. I wouldn't be entering any type of Goldman trade here, guys. XLF broke and closed below this this uptrend line from November 2012. We need to get back above it today. If not, I think the banks are going to add fuel to the fire, and we're going to see additional selling as well. And let's see, Apple. Apple, not much of anything. Actually was acting quite well in the morning and just kind of hit the top here and rolled right over. So Apple, dead money. Let's, me personally, I have no trade in Apple. We're stuck here in this section. I like to see it get down here, maybe to 200, and then buy it when it touches the area, right around this area for a trade. Your stop would be below, obviously, the 200-day moving average. And lastly is the Qs. As you can see, technology, semiconductors hold up very, very well. Networking's holding up very well. As you can see here, we're doing okay here. So that's really it, guys. But keep an eye on this market. Now, we are oversold. We're down many days in a row, 11 out of 13. Logical spot for a bounce. But again, if there's no resolution, nobody's going to be looking to step up and buy the market here until we get some sort of resolution. Markets hate uncertainty, as we all know. All right, have a great day, everybody. Tomorrow there will not be a morning call. I will resume the morning call on Thursday and, of course, Friday. Have a great day. Be safe out there. Take care.